Sorry everybody, I was not able to get onto the server, so I'm going to just post this out onto my old YouTube channel, and then later when I know everybody's picked it up, I can delete it there later. So you guys know I'm not a Palantir fan, but we keep talking about it, so let's actually commit to put it on the agenda as one of the potential buys. So this is my background on Palantir, and if anybody has anything to say, you're just wrong, you're all wet, great, we can deal with that, but I want to jump ahead and let you guys know what's in my head, and then we can go from there. First, who is Palantir Technologies? What do we know? But before we get into that, remember, we have this discussion every time. We're looking for profitable flywheel growth companies like Amazon, not companies that are out there selling dollar bills for 95 cents at a loss so that they can show how great they are at growing. We're looking at price stability to date. These companies that their price goes up and down 50 to 100%, we can't put them in the portfolio. You can't buy margin against them. You can't put options against them because of the cost. It's just there's a reason they're unstable, and until they settle, we can't mess with that. We need companies where management's committed and holds the stock as an investment, not they get options and they dump them whenever they vest. Warren Buffett, guys like that, that they hold their company stock. They take out, I think once you've taken out more than 100 million, you've got all you're ever going to spend in the world. And beyond that, you're just taking it out because you think something's better than your company. The other thing we need to do is look at the market price and look at it as adjustable, viable valuation. Meme stocks always end badly, just a question of when. So now, do we know the business, its story, which companies it acts like? Don't give me buzzwords, but actual facts about the products, the customers we know, and the competitors that we know are competing with them. This isn't any kind of advice. I'm just asking for your input to see what I missed before we make decisions on what's going next into the portfolio. Remember, history rhymes. Which company does Palantir act most closely like? And that should give us a sense of who to compare it to. Maybe I'm all wet. Maybe this is another Netflix. Maybe we're missing it. So again, and we aren't saying good company, bad company. We always focus on price because there's plenty of bad companies at great prices. Look at Altria, the cigarette company, and what we did there. There's plenty of great companies at horrible prices. We've faced that with Spotify and Snapchat. So remember, even Buffett has a sell price and a sell date. I wanted to remind you because I think somebody pointed out, oh no, he doesn't. He holds everything forever. Well, here's a little bit when I went out with ChatGPT and checked where Buffett went in and did less than 2 year deals at Solomon Brothers, Goldman Sachs, Bank of America, PetroChina, Snowflake, and what they're doing right now with BYD. Even the most hold forever buyer out there has a buy price and a sell price. Even on his own company, we know that Berkshire has a buy and sell price, and right now they think it's better to invest in US Treasuries at the 4 to 5% they're getting than to buy back their own stock. So we aren't looking for, is this a good or bad company? This might be the best company in the world. Carp may be the best CEO and Palantir might be the best company, but is it at a price that we can do something with to buy some groceries? So the first question is it a meme stock and does it have a retail following? And we've talked about this before. If you've got a big retail following, that's not going to help you. That's going to build instability. Now, if it has a retail following and professional analysts, then that's a great thing. Then you've got a Netflix. But with all these professional analysts, they've got a bunch of MBAs assigned to the project. They do regular site visits and sit down with management. They've got massive databases and comparable tools. They can go into the company software and test it out and see if it works. Who's smarter in the long run? Retail can give you volume and fight the shorts, but the big players know something. So why do the big players get outsmarted? Typically it's for two reasons. They're risk averse and they just don't like the potential risk. I think Tesla, SpaceX are perfect examples. Musk has no problem betting the farm all the time And if you're managing pension funds or trying to keep a long-term job at an ETF, you can't do that. So in some businesses, it's about the risk. And sometimes, like with crypto, they just have no clue how to value it, and they aren't gamblers. They have to put a valuation on and say, we're getting in at this and out at that. They can't do that with Bitcoin, so they're not. So with Palantir, this is a straightforward business with easy cash flow modeling. Why don't professionals want it? They know how to value it. They know how to project the cash flow. What are the risks and why are they staying away from it? So it's not like the examples I give here where, if you look at like a GameStop and if you bought right, you were a genius, but if you didn't sell right, you got burned and eventually you get burned. Same with all these other players here like Carvana, Cost, Square, BlackBerry. We are not in the meme stock game. But if the memes are there and the professionals are there, that's worth looking for. What we're really looking for is steady growers for the future. This at the bottom is a stock chart for Berkshire in the black line, and the others are Costco, Amazon, Apple. These companies all had a flywheel. That means they got something out there that the more their business grew, the more it fed on itself like a forest fire and just kept growing. There was no way mom and pop retail could compete with Walmart because they're trying to compete on price and not having the selection. They'd have to destroy their business model to keep competing. So that doesn't work. And then the same thing with Amazon. If you're a big box retailer and you're going to try and convince your customer to go to your website and buy remotely, you're training them to become Amazon customers. So they had these models that were like forest fires. That's what we're looking for on the risk side of the portfolio. Is that what we have here or not? So let's talk about that a little bit. Do we know the business and we didn't know who it mimics? Not buzzwords, not names of software, but actual facts about products and customers, and do they have a flywheel and how does it work? So does Palantir have a flywheel that grows on its own? What are the products and who are the customers? And does that work or does somebody need to feed the animal? The product is data analytics. I hear a lot of this AI, artificial intelligence stuff out there and a lot of flashy PowerPoints, but here's the news flash. Palantir owns exactly 0 NVIDIA processing center chips. They have exactly 0 AI level processing computer systems. They do not own any data warehouses. All they have is data analytics software. Now, I say all, that's an incredible thing, but it's a traditional data analytics system similar to what Meta does with eyeball data from all these disparate sources, or Amazon does with all these different customer bases all over the place, whether it's you talking to your Alexa, what your Roomba's doing, what they see on your Ring doorbell, that all tells you if you're going to buy a new t-shirt or not. They all have this. Oracle does this with so many manufacturing clients and has been for a couple decades already. So why is it that Palantir has this special sauce? What is it about their data analytics that the others don't have? And make sure you have done some research and looked at it to make sure you know, not that you're just me tooing some YouTube video somewhere. So where Palantir stands out, that it uses its data analytics system in large, clunky customers with really old government systems and a lack of technical skills to do anything themselves. Government agencies are over 55% of the revenue. Inside of that, the Department of Defense military is almost all of that business. Non-government customers are quasi-monopolies tied to government. So they've got Airbus, British Petroleum. Airbus might as well be government. So their customers are these big, slow-moving behemoths that demand coddling and hand-holding every step of the way. Look at this stuff that's going on with the FAA right now. At no point are they talking about automating it. They're talking about getting more air traffic controllers like it's still 1975. The big key advantage that Palantir shows is that their customers are really hard to sell to. Make sure you go find somebody that's sold to a large government vendor like military. They talk about taking government buyers out golfing over and over and girly bars and buying them drinks and all this hand holding. And my understanding is that not much has changed in this market over the decades. Palantir has its customers because of its sales process, its hand holding. It's making a huge effort to get those contracts signed, not its data analytic products, how they transfer that product to compete with Microsoft Dynamics or SAP or Salesforce or the host of others that are dramatically lower in cost, larger in scale, and wider in data analytic capability for customers who don't demand free drinks and tea times to get signed up on a contract. How does Palantir make that jump? If they can't make that jump, then it doesn't matter because it's overvalued. If they can make that jump, then the next problem they've got is that the Mag 7 are always watching. If Palantir does get into a mass market, it'll get the same thing that Instagram, Skype, YouTube, and a host of others all faced. They're going to get a call from somebody at Google or Zuckerberg or wherever, and they're going to say, hey, we're going to buy your company from you for X. And if you don't like it, we're going to spend twice as much as that and run you out of business and take your customers away. How do you like us so far? Here's the check. Go cash it. And then they're going to be acquired by a Mag 7. If I'm looking at it and saying who's most likely to acquire them, I think it's either Oracle or Microsoft. But unless they stay in their small niche market, that's it. If Palantir finds a way to sell to mass markets, then it's that secondary game. But neither of those has happened so far. So that's way down the road. So let's talk about if it's, the concept of an overpriced bubble. Assume for a second my assessment of the company and its data analytics system is completely wrong, and that in a couple of years they're doing personal tax returns, stealing business from Intuit, and people are buying it in $10 increments. Great. But are they still overpriced because they're priced for perfection, for growth into mass markets with profitability as they grow? The stock chart that we've got up here is Cisco System from 2000 at the time of the tech bubble until today. Cisco System has beaten sales estimates, growth estimates, profitability estimates. Back in 2000, we all knew the entire internet runs on Cisco. You can't run it without Cisco. This new internet thing, gonna have to have Cisco. We were willing to pay anything for that stock. It didn't matter. And we were paying up here. Now here we are 25 years later, and it hasn't gotten back up to that level yet. Same thing happened with other players, Qualcomm, Intel. A lot of these tech companies, they were just priced to perfection, and later players came in, took their markets from them, or existing players competed, and they just did not maintain that valuation. One rule of thumb with that is how quickly a company goes up is how quickly it can come down. If a Berkshire builds slowly over time, it's going to take time to knock it down. When GE fell apart about 5 years ago, it took several years for it to fall apart. So I'm scared that we are here on valuation for Pentair, for Palantir, and I'd rather buy it down here. So I think there's other things to look at. It's worth being patient, but tell me I'm wrong. Tell me this is not an overpriced bubble, a good company with a bad stock price. We've talked about, profitable flywheel. We've talked about price stability to date. Stocks that are volatile will continue to be volatile and make it hard to purchase them. I didn't put a stock chart up here, but Palantir has lost more than a third of its value several times since going public. And it went public in 2020. It lost a third of its value once already in 2025. This is a volatile, dangerous stock to own. So if you do decide to go into it, we're talking about one of those things that's less than 1% of assets, because if you put a significant amount in and you guessed wrong, when do you buy this? Do you buy the dip and it dips further? Do you buy it on the momentum and it turns on you. This pricing history, because history repeats, gaps fill. Palantir looks really rough with this. Next one is that do you have management committed and hold the stock in as investment, not just options that they exit whenever they vest? Financial Times says only Zuckerberg has sold more company stock than Karp. The stock ownership program doesn't go down to the masses like an Amazon or a Walmart. It's for the execs. It's for Karp. It's for Peter Thiel and those folks at the top. And they've got a history of dumping it as soon as it's vested and they can get rid of it. So if these guys believe as soon as it's available to dump, they're going to dump the stock, what message is that sending to you? It's one thing if a corporate exec is selling corporate stock to build their summer home or to buy their family private jet, but the folks doing this at Palantir, they've already sold hundreds of millions of dollars worth of stock. They can all afford to have as many houses as they want, as many private jets as they want, go wherever they want. They're continuing to dump this stock, and that must be because they think there are better places to put their money. So I'm concerned about that. The management's lack of commitment and fortitude to the company and the stock is a huge indicator, and it's just not there. So the next question is market value is justified at a viable valuation. Meme stocks end badly, and a question of when. We talked about that too. So if you look at the stock performance, it's up 60 to 70% already year to date. Today as I'm doing this, it's tanking, but it's just way, way high priced. The PE ratio is 549. Now, it's one thing if you have a PE ratio of 549 because you're on the edge of becoming profitable and you're a startup and you're starting to enter profitability. But these guys have been around for several years. They've been profitable for years. It's not like they're at that tipping point where they've been losing money and now they're going to start cash flowing. They've been generating profitability. So why would they be priced so high? PE of 549 means if you buy $549, you get $1 at the end of the year. That's not a good deal. And then the next indicator is even if the PE ratio is off, you can always look to the price to sales as an indicator of where it's at. It's trading at 68 times forward sales and 197 times forward earnings. That's the expected growth. So 68 times forward sales, I think it's more like 100 on current sales. This thing is not going to ever grow into that without sacrificing profitability as it goes. When we look at analysts, 8 of 29 analysts covering rated a buy. Now, again, you might have a situation where analysts in the auto industry cover Tesla and say, hey, this stock is valued based on humanoid robots or full self-driving, and we can't put that in our model. So we're just not going to rate it, or we're going to rate it a hold or a sell. That's not what they're saying. These 21 of 29 are saying this thing is too high priced. We're doing it because of the valuation. Median analyst target is 96. That's still pretty high because there's still a lot of Dan Ives out there and Kathy Woods out there saying buy, buy, buy on everything tech. So that's where the world sits right now. And in summary, Palantir, high growth, high valuation technology company at the forefront of AI driven analytics. I question that, but so be it. A couple of questions when I had my chat with the LLMs were they've got a new partnership with Divergent Technologies, trying to break into manufacturing. What's that going to do for them? Is it going to give them some of that business outside of their large behemoth government customers, but at what margin level? They're also talking about the insider selling. Apparently, Karp has another almost $1 billion worth of stock, 800 million he's going to dump. If this is such a great thing, why is the CEO dumping almost $1 billion worth of the stock? This is crazy. And then this whole trading at a price of sales of over 100. If you're trading at price of sales over 100, you've got to have a product that has a future mega mass market to all the consumers with a way to get to it. You need to be an Apple phone or a Netflix account or a Spotify. if your customers are big government top secret databases, I just don't see how you ever get there. Um, and then you hear about the Pentagon cuts. I don't even want to get into the whole thing about how Elon Musk has cut out so much stuff. Remember, this company's largest shareholder is Peter Thiel. Peter Thiel is the guy that fired Musk from PayPal when Musk was the majority shareholder. Musk doesn't forget things. So if Musk finds a way to steal this business from Palantir and put it in what's his new XAI, that's going to be a huge problem. And who has more capability to do that than Musk and what he's doing? That's a huge risk and a huge problem because if anybody can do it, he can. He's got all the access and he can see everything, and he's got an axe to grind with Thiel in the first place. So it's a niche player. It's a great niche player, but it's still a niche player. You can't even look at the PE. So you look at the price to sales. So if you brought the price to sales down to 10 to 1, even to 20 to 1, the stock gets destroyed. I can't see an entry point at all. And no matter how good it looks, my exit point would be near 70. So I'm not a buyer. I consider it a meme stock, and I can't use it as a short hedge either because it might go all GameStop or Tesla. Now, that being said, we've had these discussions in the past, and I've been wrong about the expected results. And if this is another GameStop or Tesla during some of its run-ups before the crashes, maybe somebody's going to go out there and make money. But I can't put a financial justification to it. The only thing I can put to it is all of the meme stock pricing activity, and that's what's driving it. And I don't have enough money to risk to do those kinds of things with it. Again, remember, we got to find the handful of things that we have huge confidence in, go heavy on those, and if they don't work out, get out quickly. Well, that's what Jim Simons did on a constant, huge basis. That's what Berkshire talks about. This is not something you can hang your head on strongly because there's no way it can grow into the valuation it has. Let me know what I got wrong. Let's talk about this. And everybody send me a text when it's out there and I'll take it down off YouTube. Thanks.